Welcome to the Commodities Trade Institute podcast, your daily breakdown of the global commodities markets and the forces moving them. I am Emily Costa. Today is Monday, May 4th, 2026. We begin today with the agricultural sector, where a significant legislative hurdle was cleared in Washington. The United States House of Representatives has passed its version of the 5-year Farm Bill, a sweeping piece of legislation that governs everything from farm subsidies to food aid. This particular version is notable because it stripped out a provision that would have protected pesticide manufacturers from certain lawsuits. This move is being seen as a major victory for the Make America Healthy Again movement, which has been gaining significant political traction. While farm groups are cheering the bill's passage as a step towards stability, especially as they face soaring fuel and fertilizer costs, the bill still faces a tough road ahead in the Senate. Meanwhile, on the ground, the reality of these high costs and disrupted trade routes is biting hard. In Dubai, the culinary scene is undergoing a forced transformation. Chefs in the city are shrinking menus and ditching exotic imports like Norwegian scallops or Mexican tomatillos. With the Strait of Hormuz effectively closed for 2 months now, the cost of flying in perishable goods has jumped by 30 to 35%. It is a stark reminder that the glitzy side of the global economy is just as vulnerable to supply chain shocks as any other. Moving to the industrial heart of Europe, we are seeing a major pivot in the steel sector. Thyssenkrupp and India's Jindal Steel International have officially called off their months-long negotiations regarding the sale of Thyssenkrupp's steel unit. This was a cornerstone of Chief Executive Miguel Lopez's plan to restructure the German industrial giant into a holding company. Interestingly, the talks didn't collapse because the business is failing. Rather, Thyssenkrupp suggests the outlook for European steel has improved so much that the original assumptions of the sale no longer hold. With European Union safeguard measures protecting against cheap imports, the sector might be hitting an inflection point. While this deal is off, the focus on green steel remains, with both companies pledging to continue working toward low-carbon production. While Europe looks inward at its industrial base, the Indo-Pacific is shoring up its resource security. Australia and Japan have just signed a landmark agreement to deepen cooperation on energy and critical minerals. As Middle East tensions continue to strangle traditional trade routes, Japan is looking to Australia to protect its economy from future shocks. It's about liquefied natural gas, though Australia already provides 1/3 of Japan's energy. It is a strategic play for the future of technology, with Australia set to provide nearly $1 billion in support for critical mineral projects involving Japanese firms. We are talking about the building blocks of the modern world: gallium, nickel, graphite, and rare earths. Turning our attention to the energy markets, the divergence between global prices and domestic reality in the United States is becoming extreme. Because of the war in Iran and the subsequent blockade of the Strait of Hormuz, 20% of the world's liquefied natural gas supply is currently offline. This has sent prices in Europe and Asia screaming higher, up over 100% in some Asian markets. However, back in the United States, we are seeing a glut with nowhere to go. While American producers exported a record 2.71 million metric tons of gas to Asia in April, they are hitting a physical wall. Export plants are at maximum capacity and pipelines are full. In the Permian Basin of West Texas, prices have actually traded below zero on some days. Essentially, producers are so awash in gas they cannot move that they are paying others to take it away. It is a classic bottleneck that won't see meaningful relief until new pipeline projects come online in late 2026. This brings us to the crude oil market and the geopolitical chess match currently playing out in the Gulf. President Trump has announced that the United States will begin a defensive mission to guide stranded ships out of the Strait of Hormuz. This is a massive undertaking involving 15,000 military personnel and over 100 aircraft. The stakes were highlighted almost immediately when a tanker was reportedly hit by projectiles shortly after the announcement. While crude prices have hovered around $100 a barrel, the market is on a knife edge as Iran reviews a United States response to a peace proposal. Washington is demanding Iran give up its stockpile of over 400 kilograms of highly enriched uranium, while Tehran wants an end to the blockade and a withdrawal of forces. As this conflict drags on, the impact on Asian refining is staggering. In April, Asia's oil imports plunged to their lowest level in at least 10 years. The region's refineries lost about 8 million barrels per day compared to pre-war levels. While South Korea and Japan are trying to fill the gap with record imports of United States crude, South Korea taking 865,000 barrels per day and Japan nearly 500,000, it simply isn't enough to offset the loss of Middle Eastern flows. If these refineries are forced to cut their run rates further, we are going to see a massive tightening in the supply of refined products like gasoline and diesel, which will inevitably push global prices even higher. Finally, we look at dry freight and the shifting flows of essential staples. For the first time in 4 years, India has returned to the global wheat export market. Thanks to a bumper harvest and record high global prices, Indian wheat is once again competitive. We are already seeing shipments moving from the port of Kandla to the United Arab Emirates. This is a vital release valve for global food security, especially as countries like Jordan issue massive tenders for hundreds of thousands of tons of milling wheat to secure their own supplies amidst the ongoing regional instability. It is a world of bottlenecks and breakthroughs where the geography of trade is being rewritten in real time. If you found this episode valuable, be sure to subscribe, share, and leave a review. Find us online at commoditiesinstitute.com.